So we'll be looking at private capital, private equity, and private debt, and what are the diversification benefits as opposed to investing in public capital such as bonds and stocks. So we'll start off with what are the features and characteristics of private equity and private debt versus your stocks and bonds. So stocks would be public equity and bonds are public debt. And then what are the diversification benefits of private capital? So, what is private capital? Private capital is the funding provided to companies that is not from public equity or debt markets. So, let's say this is a company, it can get equity, it can get debt, right, as a source of financing, and then it invests in whatever assets it wants and does its business. Now, this debt could be coming from a bank loan, it could be coming from issuing of bonds. This equity could be coming from an IPO that this company might have done, right? From the stock market investors. Or this debt could be coming from a private debt provider, and this equity could be coming from a private equity provider, right? And these are both forms of private capital. So that's what we're going to look at, right? Private equity means investing in private companies or public companies with the intent to take them private. Now, what does that mean? See, if you're investing into a venture startup and it's not even public yet, right? So that's purely a private investment, right? It's also the stage, it's also the case where you're investing in a very mature company, right, which is already public, and you actually buy it to take it private because public companies face a lot more scrutiny. They are under a lot stricter regulation. So the logic here is to take it private and then fix it up a bit and then maybe even bring it back to the public at a higher price. So that's a different strategy. This is a different strategy. Both will come under private because this is obviously private to start with. And this one, even though it's public to start with, but because you will take it private after buying it. So hence, this is also a private equity strategy. And these companies that the private equity funds invests in are called their portfolio companies because they form the private equity fund portfolio. Right. So these are the three categories. And I would like you to understand this from a continuum perspective that you have VC over here. You can think of them as baby companies, right? And then you can have your growing adult and you have your oldies over here. So your leveraged buyouts, let's say number 3, let's give it number 3, VC number 1, BB, and growing adult number 2. So this is your continuum where private companies invest in venture capital. Of course, it's a completely different type of investment. Usually you're looking for some kind of new technology, new app, right? Ubers, Airbnb, when they started off, of course. Now they are a growing adult, or maybe even moving towards becoming oldies, but they were once a baby, right? So if you got in on them early, well, that would be an example of venture capital. And venture capital, the whole name of the game is getting in as early as possible. But then please keep in mind the risk is also very high because you don't know if this is going to be successful or not until later on. Then in the middle, you have these growth capital investments where the company is already there, the business is there, but they need money to expand, and that's where private equity can come in. And then you have this other extreme, which is your old companies, which are actually kind of dying and not doing so well. So here, it's a completely different type of investment. Here you just try to improve the efficiency, maybe even take them private. They're probably already public. You take them private, you fix them up a bit, and then you resell them. So we'll talk about all three. And let's start off with the leveraged buyouts. And again, I think a very good example here is Hilton, Blackstone purchased for 26 billion, and we talked about this earlier, right? Of which 74% was debt. Around 20 billion was debt. Only 5 billion or 6 billion was Blackstone's. So why we use such a huge amount of leverage in this is because Hilton or any company which would be a LBO target is going to be a stable company with predictable cash flows. So whoever is going to be the bank behind the private equity fund providing that debt, right, will be comfortable doing it because they know that it's going to be used to purchase a company which is well set. The cash flows are stable. Now, the profitability might not be that great, right? But the bank is not really interested in profitability. They're not giving equity, they're giving debt. So they just want their interest on time. So that's what happens in this type of investment, right? Significantly financed through debt. And yeah, that's what we talked about, that they used a little bit of their own money, a lot of bank debt, and maybe even issue bonds. So both of this will be consisting this is part of that debt, the leverage. So here you have an example that you're buying a company for 100 million, only 20 is your own, 70 from the bank and 10 million from equity. So essentially 80% financed by debt, right? Leveraged. I gave you a real world example of 74%, and that's in billions, not even million, right? So that was 26 billion US dollars. And if I'm not wrong, Blackstone, when they offered to buy Hilton, the share price was around 20. They actually paid double and bought it around 50. And 5 years later, I believe the share price was $120. Very interesting deal. You can look into it. So how did they take it from 40 to 120? I mean, what did they do? Well, obviously, they bring in a lot of debt, right? They increase the leverage. Because they have a good reputation, Blackstone, they are able to get that kind of debt from the banks at very good rates. So they increase the leverage at very good rates. So the cost of capital of the company goes down a lot. They have that expertise of management. So they bring in new management, right? Which, by the way, is called a management buy-in. And we're going to talk about it shortly. Management buy-in, which means the investor brings their team. There could also be a leveraged buyout where the current management stays on board, right? In that case, it's going to be called a management buyout. And an example of that is Dell, where Michael Dell stayed on board. Right. Very often the public company is taken private because I told you public companies have a lot more scrutiny. They have to answer to a lot more people, and what usually happens is that they become very myopic, short-sighted, because every quarter they have to disclose and show some profitability, short-term profitability, short-term cash flows. So they're not able to really have a long-term focus. So once you take them private again, then you don't have to answer to that many people, and then you can do some long-term planning, make a 5-year plan, and unlock some growth, right? So yeah, that's the logic. They add value, increase the profits, cash flow, and then turn it around and then try and sell it at a higher price. And there could be two types: management buyouts and management buy-ins. Dell would be an example of a buyout. Hilton would be an example of a buy-in, where the company brought their own management, replaced the current management. Whereas in Dell, the current management uses the financing from the new investor to kind of buy out the old investors. Right. Now, the other extreme of this is the baby companies. Completely different risk profile, because leveraged buyouts, you're dealing with very, very mature, stable cash flow companies. Here, the cash flows are non-existent. There is no stability. There is no predictability. It's just depending on what stage you are, it could be just an idea, right? So here, of course, it pays to get in early, but the earlier you're getting in, the higher the risk there is. And yeah, let me show you the return depends on the stage, and let me show you the different stages. So this is obviously the first one, angel, and it's just an idea over here. At the seed stage, you start the product development. You can see the shape of the product, and then at early stage, now you can kind of see the business happening. You see that the company is moving towards operation, but this is still before the commercial production and sales. So the formative stage, of course, if you get in, the risk is very high, but then you get the company very cheap. Later stage financing, when you come in, the price of the company is already maybe 100x, or if not 100, at least you're going to have to pay, much more than what the people at the formative stage paid for it. And then finally, the mezzanine stage is just before it goes public, and then the early stage investors will be exiting at the IPO. IPO is the best type of exit, right? And your growth capital comes in the middle. So more established businesses, more established than your startup, but not mature, and definitely not oldie, in the sense that when I say oldies, I mean they have issues, they're not really profitable. You need to fix them up. But your growth capital, these are growing companies. They are sort of having those growth pains. They need financing to go to another level. You could also do something called private investment in public equity. So think of public companies that could issue more shares in the stock market, but instead of doing that, what they do is they just deal directly with private equity companies who give them the money. So it's much easier to actually get the capital from them. It's lower cost. But it's kind of bad for the existing shareholders of those public companies, because their shareholding gets diluted. Right? Now, the question is, why do private equity companies do all of this? Well, of course, to make money, right? So if you look at the Hilton deal, after 5 years, the share price was at 120 from 40. So that's the average holding period. Of course, case to case basis, it could be shorter or longer. And how do you exit? So the best exit is IPO. This gets you the best value for money, right? Best price. Because you're directly going out to the public at large and doing it's very hard to do. It's very costly to do. The transaction cost is high. You need a good investment banker on board. You need them to underwrite the issue and everything. So it's a lot of work, but this definitely gets you the best price. You could also do something called a trade sale, where you look for a strategic buyer. This is very common in biotech companies, where you invest in a biotech, you get the FDA approvals, and then you just sell it to big pharma. So that's a trade sale. This is not selling it to another private equity company. That's different. I'll come back to this slide. Let me just show you one more thing. A secondary sale is not a trade sale. A secondary sale is where you're selling the company to another private equity company that focuses on later stage companies, right? So maybe you got in at an early stage and then you're selling it to a later stage private equity company. So don't get confused between secondary sale and trade sale. Trade sale is selling it to somebody within that industry, and your secondary sale is selling it to another private equity investor. Now, SPAC is kind of a reverse IPO. You can think about it like a reverse IPO. What you do is you make a shell company, empty company, and you do its IPO, right? And you get the money from investors with the promise that I'm going to go and buy some private company. Now, you don't know which private company it is going to be. So when you're doing the IPO, you just tell the investors like, hey, listen, this is my plan. I'm going to go out and look for some biotech company or whatever it is that your focus is. And there'll be a finite time. That could be 18 months, 24 months, right? So they'll give you the money. You'll have that money for the next 18 to 24 months or whatever exactly that period is that's written in the documents. And you find a good company to buy, or you have to return their money back to them. SPACs are becoming very popular these days, by the way. Now, another exit strategy is recapitalization. So here what happens is if the private equity company kind of wants to stay on board, so they don't want to sell the company, they want to keep the company, but they also want to take out some or most of their investment. So what they do is after a few years, they kind of improve the company's cash flows and profitability, and they pay down the old debt. So let's say, think about it, that Blackstone buys Hilton for 26 billion, and then over the 5-year period uses the cash from the company to pay off that 20 billion debt that they had, right? And then they had their original 5 billion or 6 billion that they had put in, and then let's say this debt goes down over the years to 15 billion. And what they could do is they could maybe take another loan of 5 billion and give a huge dividend to themselves and take out 5 billion of their investment by taking that loan and paying themselves a huge dividend. So now only 1 billion of their original investment remains in the company, and they still have control, right? They still maintain control, and they can do a lot more with it, whatever their plan might be in future. So they extract most of their money out, and they just keep a little bit, recapitalize it, and maintain control, and keep it for the long play, right? Of course, the worst case scenario could be that it doesn't work out and you have to write it off. So guys, what are we talking about so far? We're talking about the investments in different private equity investments, and we're still in equity. We haven't moved on to debt, right? So what's so good about it? Well, the return. It definitely can provide higher return, but that comes at a price, right? It comes at a price. Number one, I think it's much more illiquid than your normal public equity. So you're investing in Apple, Google, Microsoft, Amazon shares, you can exit within minutes, if not seconds, right? But if you're investing in private companies, it takes years. And the added leverage in the case of leverage buyouts is obviously even going to add more to the risk. And if it's VCs, then again, startups are much more risky than your established companies. But the benefits most likely outweigh the risks, because this is a growing space. So the returns are fantastic. You get access to private companies which are not ready to come public yet because their growth is very fast. They don't want to share it with everybody, and you can actually get on board with them. Literally, you can get on their board, right, and help them actively manage and improve the companies. And it's easy to use leverage as well, because you as the private equity have a good reputation with the banks. Those small companies owners might not. So when you get together with them, you can kind of use your muscle to get more debt on board and really help them out as well. So very interesting space, a growing area within the asset classes for sure. Right. So that was your private equity. Next, we're going to have a look at private debt.